And that's what we really want to see from these numbers that are coming out right now. The weekly jobless numbers also coming out. 0.6 is the number, up 0.6% on the retail sales number for July. That is better than expected, up 0.6%. Maybe we are, in fact, seeing people go out and spend a little more because this is better than expected.
Yeah, it's a little bit better than expected. And we want people out there spending money. You know, the talk was people weren't spending enough. Now people are saving too much. People need to go out and spend money. But I think what this does is kind of open up the market again for the Fed hiking rates in September. You know, whether it's September or October, I think the sooner the Fed hikes rates, and this number isn't going to dissuade them from doing that. The sooner we get that first hike, the better. And in fact, the futures, Dagen, are rallying right here. We're a little better than we were before the number. It is better than expected. What does this mean for the Federal Reserve is going to be the question on investors' minds today.
Yeah, it's particularly with what China has done earlier in the week, and if you see a much stronger dollar, the Fed has committed in a big way to raising, and pretty much raising in September. I don't know how they jeopardize their credibility at this point and not make the move next month.
Joe, what do you think?
I would echo that sentiment. I think, look, you know, this economic cycle is getting a little bit long in the tooth, and while that's certainly not going to push the Fed to tighten monetary policy prematurely, look, the U.S. economy is doing much better. And we can talk about the consumer, whether they're deleveraging, whether they come out and spending. Confidence numbers are certainly looking quite strong. The labor market is obviously healing. Inflation expectations, while they certainly have been a little bit soft, I think the Fed wants to tighten policy, effectively pull that medicine out of the economy as it's no longer sick.
Yeah, and that's why we're seeing gains this morning. You wonder if these gains, though, are going to turn into losses when the market figures out that higher retail sales means the rate increase is coming next month.
You know, I think this is probably, you know, one of the most watched Fed rate hikes in history.
You're right. September 16th, big day.
September 16th, the big day. We've got another jobs report coming out, of course, before that.
No, one more jobs report. That's right.
Historically, an initial rate hike isn't bad for the market. You know, it doesn't mean when the Fed hikes rates 25 basis points that all of a sudden the market crashes. You know, that tells you that there's underlying growth in the economy. So it should actually do well for the market and do well for specifically for financials, which are a very big part of the market.
So you think it's one and done?
No, I think it's one and continues, but I think the market, on average, moves higher for 27 months after an initial rate hike. So I think you're going to continue to see the market. As long as the economy can support it, I think the market can move higher.
And you talked about the savings rate going up to 5%. Finally, the people who have been safe with their money will get rewarded if interest rates go up. Those are the people who have been, you know what, over the last, since the financial crisis.
That's absolutely right. So a lot of things to consider. We want to look at wealth management and allocating capital, putting a portfolio together. It certainly has been an eventful summer, a debt crisis in Greece, roller coaster ride in Chinese market, and of course an earnings story that was mixed. Today we got news out of the European Central Bank, the ECB saying volatility in Chinese markets may have an impact more than expected on the Eurozone's fragile economy. So there's that as well. How do you put a portfolio together, Joe? What are you telling clients?
I think, you know, to what you just pointed out, there's no shortage of headlines and there's no shortage of risks, but we really want to weigh the possibility of things going wrong relative to the probability that things go right. When we look at the global economy today, we see an improving economic backdrop, and it's really going to be led by the developed world. We think that interest rates are most likely going to go up, of course, as the Federal Reserve begins to tighten monetary policy, and so we see more upside in the equity markets relative to fixed income. I think it starts there.
I know what you're saying in terms of the Fed wanting to get it out of the zero level, but, you know, let's not underestimate the economic recovery of Europe. I mean, the ECB is coming out with the minutes from their last meeting and basically saying it's disappointing. GDP is not where it needs to be in Europe or the U.S. How does that play into the Fed's moves?
You know, I think it's something the Fed certainly considers, but I don't believe the Fed is going to make monetary policy decisions based on what's happening in Europe's economy. And let's not forget, despite this whole episode that we just saw in Greece, economic momentum, whether it's sentiment or whether it's manufacturing composites, are actually picking up in Europe. We're actually expecting growth to pick up closer to 2% in Europe over the next couple of years.
What did we find out earlier in the week from the International Energy Agency? That the growth in demand for energy is running at the fastest pace in 5 years. That's not a world economy that's on its knees.
That's interesting that, you bring that up. But let me take you back to the U.S. for a second. Retail sales better than expected. Yesterday, Macy's wasn't good, the numbers. Kohl's Kohl's, KSS come out this morning. They missed the expectations. Cisco was strong, so that maybe is a positive because it indicates business spending. But you got Applied Materials, AMAT, after the close tonight. What do you want to say about consumer spending relative to business spending, CapEx? That was supposed to be the thing that brings us out of this sort of malaise in terms of the economy.
CapEx in general, and I think if you look at the manufacturing industry here in the U.S., that's probably the one area that we haven't necessarily seen the rebound following the soft first quarter that we would have liked to see. You know, we characterize the consumer side of the equation doing quite well. The manufacturing side of the equation, it is still lagging. But overall, you know, we think the U.S. economy is still looking quite good. You've got both cyclical and structural forces, I think, lifting the U.S. economy over the next couple of years.
So how do you allocate capital then?
So aside from being overweight equities relative to fixed income, we're also making an overweight call in the U.S. economy. You know, we have conviction in U.S. equities. We think earnings season, while it certainly has been a little bit mixed, if you remove the impact of lower oil prices and you push aside energy, you're still looking at roughly 9% year-over-year growth this quarter. That is fantastic considering we've had a really weak second quarter. I also think you want to take a look at Europe. You want to take a look at Japan. You've got very accommodative and easy monetary policy. Of course, as you begin allocating capital over there, you have to be mindful of what's happening with those currencies.
So you want to hedge out the currency going in Europe and Japan?
Going in Europe and Japan, you want to hedge out those currencies. And of course, we can't forget the emerging markets, considering what's happening in China and the prospects of higher interest rates. You know, I think back to the taper tantrum in 2013. I certainly don't think it's going to be as rough, but we are very, very cautious.
Taper tantrum. I remember that. We'll see if that happens again in September.
Let's hope not.
Joseph, good to see you.
Good to see you.
Thank you so much. Joseph Tanious from Bessemer Trust there.